Hello and welcome in part 3 of the mini-series about divergences. In today's section, we will continue to discuss the real market usage and strategies with the divergences, since we already cover all the types and basic knowledge. So now let's move on to discuss Awesome Oscillator. So unlike the oscillators covered previously, the Awesome Oscillator divergence indicator looks like a histogram, not like a curved line. So the trading strategy with the Awesome Oscillator is similar to that of the MACD histogram. The chart, as you can see right now, displays the Euro-USD sell trade entered according to the bearish divergence. Next, the sell trade is exited with a profit and a long trade is entered after the regular bullish divergence appears. So the entry levels for both a short and a long are marked with a blue horizontal line. At the entry points, the Awesome Oscillator breaks through the zero line. I marked the entries with the green circles. And an important feature of the Awesome Oscillator is that the signal is sent when the indicator crosses the zero level. So when the Awesome Oscillator breaks through the zero line, the local or the global trend should reverse. So when the price extremes are separated by such a crossing, cannot be the same signal pattern. So to avoid such an error, you should check the same divergence on a longer time frame. If the signal is not broken there, you can use it in trading. So now we move on to the Bollinger Bands divergence indicator. So I have already mentioned that the Bollinger Bands are well combined with the divergence signal. And BB is a trend indicator, so we need an oscillator to define a divergence. So we will take, again, the MACD as an example. In short, it suggests attaching two Bollinger Bands indicators to the price chart. One indicator is coefficient 1 and another is with coefficient 2. So finally, the chart is divided into three zones, where the central green band is a neutral area and the red bands upside and downside are the buyer and seller zones. So the common strategy of double Bollinger Bands divergence suggests that if a reversal followed the upward trend and the price entered the bottom red band, there should start a bear trend. And in the opposite situation, when the price enters the top red band where there should start a bullish trend, it is clear from the chart that the strategy also delivers false signals, as any other strategy do. So divergence here is a good filter. And so in early May, as you can see from the chart, the Euro-USD pairs entered the upper red zone and breaks it through. However, the MACD paints lower highs. This is an example of a regular divergence. Besides, the price divergence from both the MACD and the MACD histogram as well, which is an additional confirmation. So if you discover such a signal on MACD, the trend must soon reverse. So to confirm the short entry, we don't need to wait until the price goes into the lower red band. We enter a trend earlier when the candlestick closes in the green zone while the histogram goes into the negative area. And so we put a stop loss, a little higher than the most recent local high, and we should exit the trade then when there is an opposite divergence signal of the trend reversal. And so it is clear from the chart that the signal is delivered in January. So we exit a short trade and enter a long one. So you see that the combination of the MACD and Bollinger Bands makes up a very good trading strategy. Besides, due to the special design of the MACD, the indicator gives a divergence signal both on the histogram and using moving averages. You see from the chart that we avoid false signals due to the double divergence check. In our case, the MACD histogram shows the bullish divergence, but moving averages do not confirm the signal, so the signal is false. Okay, now is the time for on-balance volume. The on-balance volume indicator refers to indicators of trading volumes. It is based on the idea that trading volume is the determining factor in price movement. And so the OBV measures the change in trading volume and adds or subtracts it from the previous value. So the trading volume is added to the previous value if the price closes higher than the previous day. if the price closes lower than the previous day, it is subtracted. Thus, the OBV indicator shows the relative strength of bulls and bears in the market. And so divergence on the chart may occur if the direction of a price movement and OBV are different. So when the price rises and the OBV falls, this may indicate possible price reversal down in the near future. If the price is falling and the OBV is rising, the price will likely turn up soon. So what is the best divergence trading strategy, you may ask? Well, using the combination of MACD and Bollinger Bands as an example, we see that trend lines and other oscillators can be used to filter the divergence signal. In addition to MACD, we have already explored Stochastic, AO and RSI. And these indicators are effective at handling the divergence signal, but perhaps they will work even better together. So let's try something out. I do not want the divergence strategy to be too complicated, so I will employ the following tools. First one, we have the Stochastic with settings 21, 7 and 7 with EMA to the smooth. And then we have the RSI with a period of 14 and double Bollinger Bands as previously mentioned. So, Stochastic and RSI, in addition to confirming divergences, will also signal overbought and oversold conditions. For the Stochastic, I took the recommended settings 5, 3 and 3. And as for the RSI, I used the default ones. So, Bollinger Bands will serve as a trend indicator. A stop loss is set a little higher than the high, or, of course, a little lower than the low. So we will take the profit when the indicator goes into the overbought or oversold zone. So let us test the divergence trading strategy in the same case where we traded with the MACD. So first point, there is a clear divergence between the price and the Stochastic. The price is now in the upper Bollinger Band above the moving average, so the trend is bullish. Based on this signal, there is a regular bearish divergence. Second point, the price breaks out of the upper Bollinger Band and goes back into the green zone. RSI touches the overbought zone and goes down again. These signals confirm the trend reversal, so we detail the entry point. Number 3, we enter the short at the next bar when the Stochastic shows the bearish crossing of the percentage K and percentage D lines, which are in the blue circle in the chart. So, fourth, the Stochastic goes up into the oversold zone. RSI is in the balance zone, so it doesn't confirm the oversold conditions. Hence, a false reversal or consolidation can be expected, but not a trend reversal, which is marked with blue circles. So we keep the short open. Fifth, eventually there is a bullish correction. So there is no evidence oscillators are in the balance zone, so still we hold the short. Sixth, in late October, both oscillators entered the oversold zone. So when the price rolls back and the first bar closes in the green zone, we exit the short and take profit. As a result, the reversal signal turned out to be false and the price continues falling. However, there is no entry signal. And so next, there is a regular positive divergence, so we enter a long. The signal to exit the trade according to the oversold zones appears only in June, which is marked with the green circles. And so, as a result of such an easy test, we can conclude that this divergence strategy is, we could say, entirely accurate. Because of that early exit, however, we could miss the rest of the strong movement. But in fact, there is no point in trying to pick up price movements. If a strategy yields stable profitability without deep drawdowns, it already could be used. So, try this algorithm to develop a divergence day trading strategy yourself. You can also experiment with the settings and use completely different oscillators like the Awesome Oscillator, for example. So, let's discuss divergence accumulation principle. When working with indicators such as the AO or MACD, you might have noticed more than once that after giving a divergence signal, the indicator does not work it out. But on the contrary, it forms one more high or a low while not crossing the zero line. And we see not 2 peaks, but 3 or even more. So the most common opinion is that it's just a statistical error in the testimony and leaves no other option than to close the position by stop loss. But if we look at further development of the situation on the market, we will see the signal is not cancelled but simply transferred to another time and market situation. In other words, the signal accumulates and a double or triple signal appears. So why does it happen? Well, we could say this is easy, but we estimate the divergence not by the whole current trend, but only by its part. In other words, our initial signal means a local trend change within the global scope. So this local trend change is called a correction. So the indicator shows the presence of divergence at the moment of the beginning of the formation of the correction and after the correction, when the main trend continued. The indicator quickly realized its mistake and started following the price without changing the global trend, meaning not going beyond the zero line. So when this trend is over, the indicator gives a divergence signal again, which is now located as though inside the previous signal. And now this is a single signal, and this may continue until the global trend changes. So this chart shows our trade, and you see that before our reversal signal there was a divergence on the MACD histogram marked with a circle. And I must tell you that the MACD moving averages do not confirm this signal. However, such multiple convergence divergence only increases the total chance that the divergence would work out. So now, finally summarizing, let's we could say summarize everything we learned about divergences in those 3 already episodes. So I could sum up the main conclusion and recommendations on divergence trading as follows in those points. Firstly, divergence signals alone are not enough to enter trades. Confirm the divergence with the technical indicators. Next, if you are confused with the different types of divergence, learn the major type, which is the regular divergence throughoutly. The regular divergence helps to identify the trend reversal and enter a trade at the top or bottom of the trend. Next point, be sure to spot the divergence correctly. Check yourself with a checklist. Rewind the video to the section devoted to the common mistakes where trading practice, which was, I think, in part 1 or part 2. Next, consider multiple accumulating signals when analyzing divergences. Next one, the presence of divergence in longer timeframes enhances the meaning of divergence in shorter timeframes, of course. Next, the divergence signal is similar in all platforms, so you can trade the divergences in any market. So there is no universal indicator to work with the divergence, so you should experiment with many different divergence signals and try different combinations of technical indicators. However, do not take unjustified risks. Always test any strategy, for example, on a demo account. So guys, that will be all so far from my side. Of course, if you like this episode, this series, subscribe to the channel, leave a like if you want more, and I'll see you in the next one. Take care and goodbye.